So I'm turning on record, and then also going to share a screen with you. So I know this is going to be absolutely the most interesting webinar anybody's ever watched and listened to on finance. Our original presenter had to cancel out, so you've got a substitute, otherwise known as me. And I was telling Rick Moise a story. My dad worked in the Federal Reserve Bank as an auditor for his entire life, other than his break for Army service in World War II. So my brother and I grew up hearing about Fed monetary policy, banking, and all kinds of other stuff every night at dinner, and swore, both of us swore we would never go into finance or business, which we didn't. However, I think it's in our genes, and we, in some strange ways, I actually enjoy this type of stuff. But the point of this presentation and the time we spend talking about finance is not to make you a CFO. That's not the point of the exercise. But it's really to help prepare you to ask questions, whether you're in a church or inside an organization within a social service agencies or even the national headquarters of a church. And have some of these concepts sort of in the forefront of your mind to keep that organization out of financial trouble. So here's the topics we're going to look at today. And I know, hold your breath, there's audits, profit and loss sheets, and net assets on this list. I mean, now we're talking really great finance things. But I want to recommend, and again, I'll have these slides will be posted in the Dropbox for presentations. But I want to encourage you, and again, this book is not an MBA or a business major level book on financial intelligence, but it is something sort of in between that is meant, again, to prepare somebody to understand what they're being told as a leader, and then also be prepared to ask the correct questions. And what I really like about this book is it helps you, excuse me, understand the assumptions that underlie a lot of things that may happen within your organization. So again, not trying to sell this thing, but it's $25 on Amazon. And at best, you can put it on your bookcase and intimidate people just by having the book there and trying to impress them that you know about finances. And by the way, feel free to interrupt me as we go through this. I thought sort of some definitions might be really useful as we begin, because we hear these terms, not-for-profit and nonprofit, sometimes used interchangeably. Each one falls under a separate section of the IRS code and have different outcomes and functions. So a not-for-profit, you can see there, falls under 501c7, and that's actually a organization that's put together for the pleasure of the people inside that organization. So let me give you an example of something like a 501c7. There might be a golf club or a social club near with you, a country club. Those would all be categorized in the 501c7 category. We've got a thing here in Austin based on our German heritage called the Sängerrunde, which is actually a German singing group that, of course, has a lot of bars and a bowling alley, but that is for the sole purpose of enjoyment of the members. Within that context, that money that members' dues and fees they pay in are not taxable. However, if the organization does have investment income that produces income, that can be taxable. We are all much more familiar with 501c3s, which are the nonprofit side of this house. And the way the IRS looks at these things are built for some type of social cause or advocacy. And I'm sorry about that. I should have my phone completely turned off here. So what's interesting, everybody thinks a 501c3 can't make money. Oh, by the way, a 501c3 can make money, and we typically aim for a margin of at least a positive 3%. But that money has to be returned back to the 501c3 for execution of its mission. It cannot be used for things like shareholders or people that might gain by contributing to the organization. So the fact that an organization is a nonprofit doesn't mean it can't have a positive revenue stream and positive end of year results. Those just need to be returned back into the organization. Typically, these organizations, both 501c7s and C3s, have articles of incorporation that are filed with the state that they exist. And then so that's a state level thing where they're articles of incorporation. And then the actual nonprofit or not-for-profit status is granted by the IRS. Now, there's lots of interesting permutations of this. For example, churches, for the folks there that are parts of churches, Aaron and Will and Ian and Andrew, your 501c3 status may be granted by the national church body and you covered under the national church body rather than your church or congregation having its own individual 501c3 status. Do y'all that work in those, do you know where your 501c3 status resides?
Yeah, it's with the national church for the ELCA.
Okay, Andrew, is that the same for y'all?
Yeah, yep, with the LCMS.
Yeah, and for social services agencies, those, for the most part that I've seen, those reside with the organization itself. So they apply and get their own independent 501c3 status. What's interesting in the university world, at least to my knowledge, all the ELCA colleges have their own 501c3 status. And a few of the Concordia LCMS schools have their own 501c3 status, but the majority of them are also covered under the national church body for their 501c3 status, which is kind of interesting and kind of a different way of doing things. So that articles of incorporation and charter, you may still have those in a congregation or social service agency. Once you get to higher leadership levels in organizations, I really suggest you get copies of both the original articles of incorporation or charters and then any subsequent changes to them, just to have a record of what's going on with your institution. They're pretty important. And if you have your own C3, 501c3 status, that you also have the letter from the IRS that grants you that status. That can at certain times be important things to have in your hip pocket. So I love Peter Drucker, and here's his kind of definition of a 501c3 nonprofit. It's about impacting people. It's about changing human lives. It's about educational processes. So we are called both by God and our organizations to do great things for people. Okay, so as I mentioned, we're going to talk about a couple things, and I want to start off differentiating between budgeting and cash flow. Does anybody know, can anybody just do a short description of budgeting and cash flow? Want to do that?
Budget's the amount of money that you plan to spend. Cash flow is what's really happening day to day, week to week with your money.
Yeah, so you can balance a budget and still be in trouble with cash flow. And you can have cash and be in trouble budget-wise. They are intertwined, but both sides of that equation can work. And my argument is you've got to be watching both of them all the time in some periodic time frame. So basic financial plan, like Andrew pointed out, for the fiscal year, I argue that no later than 6 months prior to the end of your fiscal year, you've got to be in the framework for developing your budget for the next fiscal year. later on, we're going to talk about something that in the military we call the out years, but not only should you at least 6 months before the end of the fiscal year be working on this, but you should also have a framework already available for the out years for what that next budget should look like. So no later than 6 months, get to work on that, and even have it framed as soon as you roll into a new budget, begin framing the next one. Here's sort of some no-brainers on baseline assumptions that go into a budget. Has anybody heard the term zero-based budgeting and know what that means?
Yeah.
Andrew,
does that mean you don't carry value forward?
No.
I believe it's, yeah, you start the budget process with a zero and you assign dollars based on that zeroed out idea, not what you had the prior year.
Yeah. And who threw the carry out question? Was that you, Paul?
Yes.
Yeah, and Paul, good point. What would happen when you carry over is really that impacts cash flow as much as anything else. And you can carry over budget, but what happens in zero-based budgeting is you actually reduce the entire budget to zero and re-justify each piece of the budget. And that can be a deeply frustrating exercise for an organization, but it can also be a deeply important one for the organization to get rid of residual stuff that just keeps coming forward year after year and really makes the organization focus on mission and what's important. So when you begin to, hey Dan, when you begin to ask questions about zero-based budgeting, people will sometimes display apathy. You mean I've got to re-justify all this stuff again? And the answer is yes. And it provides a framework for the really hard questions about what do we carry forward and what do we don't carry forward? What's important to our mission and what's not important to our mission? Or if we're doing this, do we really need to do this as we move down the road? I think the other thing that follows zero-based budgeting is you've got to have a plan. It has to be done in the context of mission, values, and some type of strategic plan. So it can be a really, really difficult exercise for an organization. And you may not get it completely done, but and the reason for doing it is that you need to step back and look at the fundamental issues in your budget and the fundamental questions about mission, vision, and values for the future. Has anybody ever tried zero-based budgeting inside where you're working, either inside an office or in your organization overall?
Yes.
So Rick, can I just ask you your comments on how, first of all, it's going to take longer than 6 months. It's going to take a while to get that done.
I would say there was good news there and bad news. I think people like the idea theoretically.
Yeah.
But then you have to have at least department heads who really trust each other. Because it could be that one year your budget goes down pretty significantly because of what's going on, but then the next year it reemerges again. And that takes a lot of trust in everybody working a budget, that you're not going to be, you're not going to continue to lose with this zero-based budgeting. To always have to justify and start at the beginning is a hard, it's very hard because we don't like to keep justifying, not just ourselves, but our department's work. And you figure sometimes you've worked so hard to get where you are and you finally made some gains and then have to go back again can be psychologically almost damaging,
Yeah.
So it demands quite a bit of trust and cooperation, I think, to do this on a regular basis, and not just to do it, let's say, every couple of years or so.
Yeah, and Rick, that's a really important point. I would do, and see what you think about this. I would do this as an organization, again, whether it's your office, whether it's a congregation, whether it's an agency within inside another one, particularly as you move into a new plan for the future, a strategic plan or an operational plan for the future, to begin orienting that way. I don't think this, and I agree with you, Rick, this is not something you do every year. It's just too hard and painful, and you've probably already, once you do it, already answered the basic questions you need to answer, and behind the purpose of doing that, which is really determining what's mission and what's.
I would add one more thing, Tom, and I'd like to hear your experience with that, or anyone else's who's done this. This tends to be a natural exercise when you're going through financial troubles, because you're trying to. Everybody's got to justify the budget numbers, and people get it. Okay, yeah, we got to cut so much, and let's go back and rebuild rebuild the airplane. It's actually more effective though in good times, and probably less often attempted. But boy, because then you can shift dollars to creativity and innovation in a non-painful way, or in a less painful time. But I'd like to hear, again, I've found organizations are more ready to do this in tough times because it makes sense, and less likely in good times.
Does anybody else want to comment on that may have tried it?
Well, in all of our organizations, you're really talking about people. You're not just justifying budget numbers. You're saying, I got to have Paul Hansen on my payroll.
Yes.
Yeah, then somebody else might say, no, you don't. I mean, you're not saying I need this much for widgets. Or we're gonna not have the building next year. A lot of those fixed payments are there. The non-fixed payments are personnel, which, that's a big deal.
Yeah, Paul, I agree with you 100%. And can I follow up on something you mentioned, Paul? A really important point. When you start this zero-based budgeting, the other thing that has to go on the table are things called must-pays, and that gets to some of the things you just mentioned. You've got must-pays that, when you go to zero and come back up, and that may be electrical, leases, debt payments, those types of things as you rebuild it. Absolutely. And you're right too, that it tends to begin to focus on people and programs. I would say it's both people and programmatics. Which programs go forward with that, just like you said, Paul, also impacts people. Rick, the only time I've really done this was after we relocated our campus in good times. It was after we moved our campus, we basically, since we had gone to a new facility, we were looking at potential changes of direction, did zero-based budgeting for the next year and a half after that, because it was a fundamental change in the institution, and it was time to be able to do that, and people understood it. And we were actually in both great financial and cash flow positions then. So it's something, this again is part of the toolkit just to keep in your hip pocket as you begin these processes, and especially when this is done. And here's another thing that's a big deal to me, and is that a budget always has to be done in the context of mission, and where the institution is going forward. Again, you have to have leadership engaged on this, and I don't know whether it was Rick or Paul mentioned this question about department heads and trust that's built in these budgeting processes to move forward, and then it always essentially ends up being an iterative process until you reach some kind of consensus. I'm going to go into what you don't want to do in this process, but any comments on those kind of basics in budgeting?
Yes. What's your experience, Tom? when you say something like, "Oh, any cuts or any budgetary process should be serving the mission," I mean, we all nod our heads, but that's actually difficult to accomplish because often our financial chiefs are more worried about reporting a bottom line financially than they are the mission. That can happen. And there are certain real pressures with money that sometimes trump any reference or focus to mission. So I'd just like to hear how you've had that discipline, especially to bring your financial chiefs on board so that they would agree with you and also know how that's done. How do you keep the mission focus as you're discussing a budget? What's the discipline exercise?
Well, and Rick, I think whether it's a congregation, a social service agency, or another type of 501c3, you're absolutely correct. And I think there's three components to that. First of all is leadership, whether you're a department head or you're the pastor of a congregation or the head of a social service agency. I mean, that has to be part of your mantra is we've got to be able to execute the mission. Now the CFO, and I call the CFO in a sense the traffic cop for some of this. The CFO also knows in the long term, the only way you're going to accomplish mission is survive in the short term by having cash flow, positive cash flow, and some type of budget that ends up at least neutral and maybe positive in terms of margin. So you're right, that's the tension between these two. And I think and I'll be honest, Rick, the university are in pretty good shape, but this high school I'm working with right now, we are going to have some very important meetings. I'm not doing it much anymore. I'm helping them focus these questions. But it does come to a point where in order to balance the budget, to continue the mission, you need to ask some really hard questions about the continuance of the organization. Because, on the revenue side, you've got gifts and funding that you get tuition. In churches, you get budget, as in offerings and things, and maybe some other sources of income. But I think when you get to the point that you're talking about, Rick, where if we cut any more, we can't accomplish the mission, now you're in a question about the existence of the organization over the long term. And whether you say, yeah, sure, we can cut 5 more people, but we're not going to be able to accomplish our mission in that place. So, I mean, we've looked at options like what can we outsource that might be done better or more cost efficient? How could we potentially combine? And these are called back office operations. For example, you might think about combining 2 or 3 congregations with one financial center that would do their books and things like that. We see in ELCA universities combining back shop operations. Concordia, Wisconsin and Concordia, Ann Arbor have basically done that to become more efficient. But Rick, I'm not sure I answered your question completely, but but eventually you do face a question of, can we continue this mission with this amount of money? And we're at that place with one organization I've worked with over the last year, I think.
This is Paul. I've been thinking about in the conversation, and I appreciate where it went, because where we started, it sounded like you're going to zero everything out and only things that fit the mission can go forward. Kind of the skeptical response in me says, well, they were in the mission last year, and the mission probably doesn't change, right? The mission doesn't change. The vision might change, yes, or the environment might change. Like, we don't have as much money as we used to, or healthcare got way more expensive than it used to.
Right.
So I think that's what you were talking about. Yes. Is the conditions changed, and if we're going to have a mission at all, now we need to make hard decisions, but I'm less comfortable with, this is within the mission and this is not. Does that make sense?
Yes, yes. And I think that question of what you might outsource or not comes within that context too. For example, financial and back shop operations, HR and things are important to the mission, but there might be other ways to do that. Does that make sense, Paul? That there
right.
Other opportunities.
Or an educational enterprise, you might say, we could deliver the goods a different way, online
right.
or with adjuncts or blah, blah, blah. But
yes.
Yeah, that backroom stuff is, of course, what university, and by golly, it's kind of working.
Yeah, absolutely.
So
absolutely. And it always asks, what I like about Rick's question is these types of things do force you to ask the really important questions. And right, and here's two of my don'ts. Don't pass a deficit budget. That drives me nuts. I don't know if it drives other people nuts, but part of our stewardship of our organization really deals with asking these hard questions to move down the road. And the other trap, especially in social services agencies and also in churches, is if you've got a budget gap, what you do then is say, okay, we're going to get that budget gap in fundraising. Well, what happens in that, at least in my experience, is you end up fundraising for the short term and not having the ability to fundraise for the long term. But again, if anybody has some experience with that, even in some of my current examples, once you're fundraising to bridge gaps, not that you can't do some of that, but when it exceeds the capability of folks to be able to do, and they can no longer fundraise for the long term, that becomes a difficulty. Any comments on that?
Yeah, I think I don't even know what that means with many congregations.
Oh, good point.
Most congregations would probably pass some sort of aspirational budget and then would try to live month to month within their means, hoping to achieve what they set out to do, but trying to be realistic in its operations. So could you say more about, I'd like to hear from our people who do this, even building, there are tricks to building a budget, and you could hold yourself to, how you build a budget and what are the assumptions of the budget. Is it supposed to be aspirational where you're pushing the congregation? Is it to be realistic based on what? Last year's giving? I mean, how do you build those things? Yeah.
Great question.
What other assumptions are built into it? So we don't fall into the trap I think you're trying to suggest.
Aaron, Andrew, Ian, Will, how about from the congregational side? Any comments on that?
Well, the congregation that I'm at now had a decades-long practice of passing deficit budgets. It's out there. I'm sure we're not alone. They just they got used to it. They just always had a little bit salted away that they would transfer over to meet the budget each year. But it is possible to, at least for 1 year we didn't. We'll see how next year goes. We're hopeful. But it's hard with giving. We kind of use as a baseline what the offering was last year, and we will hope for a little bit of an increase. We try to be somewhat conservative with our estimates. But you never know. A couple families move away, depending on who they are, it can completely change your picture.
Yeah, I agree with Aaron. Unlike a lot of nonprofits, we don't, it might just be a Lutheran issue, but we don't have strong commitment links. So kind of what people give, they give. But if we did an annual tell us exactly what you're going to give and how, like a lot of nonprofits do. That'd be it would make budgeting a lot easier. So there's a little bit of just predictive work, unfortunately, with parish 501c3, I think.
We actually do ask for people what they're going to give in the year. We have a pledge campaign that you must too, don't you?
Annually?
Yeah.
Yeah, our parish culture is probably a little different then.
Okay.
Yeah, it's fascinating.
One of the things that
Go,
I'm sorry, Tom.
Paul. No, go, Paul. Go for it.
One of the ways that, I mean, of course, if you've got a calendar year pledge and 25% of the income comes in the last month,
right, December, yeah.
there's not a good way to manage cash flow,
right?
Because you end up just hoping that, you know, and then maybe you get into one of several ways of fudging it. One is go to the rich guy, you know, on December 20th and say, can you make up the gap? And he or she says yes. And then you get that kind of addiction going. One of the ways we did it in one church was we had a pledge year that was identical to the calendar year. And then we had a fiscal year that was 6 months off of that. So we felt like we knew better what the predictive income would be, because December was month 5 instead of month 12.
I know that's been true for a long time for lots of churches, and it is still true for us that December is a better month than any other one, but it's becoming less true, particularly because we've pushed so hard online giving, where you set up automatic withdrawals. That's been so helpful.
Yeah, and
I second that.
Yeah.
Could you say more about that, Aaron? What percentage of your giving units use the online giving tool?
More and more. We have, I think, 55 pledging households. I mean, it's really interesting when you look at the numbers of the vast majority of the budget comes from people who pledge, of course. And, what do we have? Maybe 120 households, and 55 or 60 of them are pledgers. And online, I think we have, it's interesting because some people who give online don't pledge. So that's also kind of funny. Do you count that as a pledge because you know it's coming in? I think we have maybe 40 online givers, online in some way, whether it's from their bank or through Banco, through our website. But,
is that 40 or 55?
Yeah, I think so. Yeah, it's quite a few. And other churches that I'm trying to emulate do it. That's where they do. They just lean into that online giving.
What we found, my church was about 1,200 baptized members, and when we got 40 households who were doing automated giving, it took the valley out of the summer entirely.
Yes.
So the summer was a flat line when we hit 40. That was the magic number for us too.
Paul, you all brought up a really important question, and I should have put it in here. I've thought about it and forgot, was determining your own fiscal year and what that looks like. Is it the same as a calendar year, 1 January to 30 December? Is it 1 July to 30 June? Is it, for higher education, we actually looked at going to the federal, we didn't, but we looked at going to the federal fiscal year, which is 1 October to the end of September. Because the point for higher education was by September, I knew what my revenue side of the equation was going to look like pretty much versus guessing at it with a 1 July, 30 June fiscal year. So I just would ask you to think about that. And I think it was Paul or Aaron's point about that could help understand your cash flow a little bit better, modeling it and things. So just throw that on the table to think about as we go down the road here, is how you set your fiscal year. Dan, I was going to ask you a question too, from a national church body perspective. I mean, your revenue side, I know how your expense side is going to have all the must pays. Is your revenue side like the LCMS brought about through a mix of fundraising and donations from various synods back into the national church body. Do you have any insight into that being over in the Mission Investment Fund?
Oh, yeah. I mean, our revenue is almost 100% driven by our loan portfolio. We have obviously cash reserves somewhere in the $200 million range that are obviously invested in the market. We have professionals that do that for us, fixed income and equities. But yeah, our revenue is purely driven by that lending piece of our business. Of course, then our beyond the personnel, the major expense line item is interest expense, and that's the funding source, the investment portfolio. So I don't know if that's the question you were.
Yeah, I was just saying, you were budgeted separate from the national ELCA.
We are a completely independent entity with our own separate board of directors, correct?
And separate 501c3 status?
Yes, sir.
Yeah, okay.
Yeah, so, I mean, budget is a rather complex vehicle for us, as you can imagine. It's not dissimilar from any other enterprise in that we're making assumptions on the market. We've got obviously interest rate assumptions, growth assumptions, cost as well that we're budgeting, but it's a very, very dynamic process and managed very actively on a quite regular basis, I guess.
And do you have assets would depreciate in your budget?
Most of our asset is our loan portfolio. Yes, we have facility. We are in a building and we have depreciating asset from that perspective. But we're kind of from an accounting perspective, we're quite unique in that our investors, all of the individuals and congregations that open accounts with MIF, that is a liability because we owe that money to them. So it kind of flips the balance sheet around a little bit. It's a little bit hard sometimes for the non-financial service person to kind of get their arms around it. But our principal asset is our loan portfolio, and that's somewhere in that $550 million range today. And that's our primary earning asset, of course, as well.
So I'd be anxious to hear, given Tom your encouragement not to have a deficit budget, how many people do build in depreciation costs into their.
We don't see that often with church as we look at loan, our underwriting folks as we're looking at lending to church. That's a pretty foreign concept given fund accounting. Depreciation is at least that we see within church space. That's a tough concept. It's a non-cash flow item. We add that back to available cash when we look at purely what's available to service debt, as we're looking at it uniquely through that lens of lending money to the church. But we don't often see, that's a really good point, Rick. Depreciation's not all that common and that we see.
Rick, great comment, because this question of depreciation in a budget, does everybody understand what that is? That you have assets that lose their value over time, and the IRS has different depreciation schedules. But what this looks at is some way of capturing the loss of values of assets that depreciate over time. So it's buildings, it's computers, it's all that kind of stuff. And so for our pastors, do you know if you have depreciation figured into your budgets? Have you heard that term used when you go into a budgeting process?
Only on the balance sheet, right?
Yeah.
Would that be right?
Well, it's in your budget too. What Dan was getting at here is that in order to fund depreciation in your budget, you actually have to have money to do that. It has to be part of the revenue side of the budget. But in fact, that ends up being, and Dan, if I'm explaining this the way you explain it, that ends up being cash. I mean, it's money you have because you generated it. And typically what we did, I don't know what you did, Rick, when you were at the seminary, but we reinvested that money into the physical plant and other depreciable assets. So we used it to fix roofs and do things like that.
Tom?
Yes, well.
Just thinking out loud. So when a church does a capital campaign, which includes improvements, in essence, they're filling that depreciation gap all at once, and that kind of goes back to your second point of relying on fundraising to bridge gaps. Is that a fair statement to make, or no?
Well, and when you're and I'm not an IRS expert on this, when you modify a building, how that changes its depreciation status and where it is in its depreciation life. What was interesting for us when we moved Concordia University, Texas's campus, our old campus was basically completely depreciated. And we moved into a campus that was just beginning its depreciated life. I mean, most of the facilities, so our depreciation, the depreciation part of our budget jumped to $8.2 million. And that we did fund over time. So Rick, go ahead.
That's a really important point. If you remodel or add value to your facility, if you do any kind of capital campaign, you're going to pay for it right away. If your depreciation is a percentage-based thing, and so that can really screw up next year's budget. You might not have a balanced budget for any other reason than the quote artificial number that depreciation is. And that always catches people off guard. You go, crap, we gotta come up with an extra $20,000 of depreciation on top of the new building we just paid for.
But if one was to include depreciation into the annual budget, then that would, in a sense, create a greater value in the capital campaign, because the depreciation, it wouldn't have to be included then, right?
I'm not sure, Ian, we're going to have to probably talk about that offline.
Okay.
Because what happens when you do include, and there's lots of universities that do not include depreciation in their budgets because they can't fund it. And Rick, you were ahead of us, and Dan, I kind of looked at that budgeting depreciation every year as a savings account that I can roll back into capital stuff and fix it.
Right.
And actually, in the long term, that's the point of the exercise, right?
I think that's right. And I think you could build on those previous comments to say, on what matters do we want to build depreciation because we want to keep up with those costs, and it might be with technology or buildings or boilers or whatever it might be. And what things are we going to depend on capital campaigns? And I think in the past, we've always, the boiler goes out, then we just pass the bucket, we pass the offering plate. But our operations have become so sophisticated, I think you have to think these things through a little bit more rigorously. To build, how much do we build in a savings account so we can rebuild the roof every 15 years, and that we've saved for that. And
yeah, and that's a great point, Rick. Thanks. Okay, two more things on budgets here to think about. One, I think if your organization has a strategic plan, you need to build out what I call out-year budgets for the plan. These should be top-line budgets, so it's a rough draft. Let's say you're building a plan for 3 to 5 years out. Rough drafts, top lines of budgets. So when you go from year to year, you begin this process up here of rebuilding for the next year. You've got draft budgets in the bag already. And just to help some on this, here's a web, and again, I will send these slides out to you. And this is sort of a 10-step budgeting checklist for building a budget in a nonprofit. So I just throw that on the table for help doing that. Here's a cash flow chart. What's really important about cash. So budgets give you a snapshot at a time of, and especially at the end of the year, whether you manage to close the year out with any margin, positive, negative, or zero. What cash flow tells you is takes a finer look at that to help you understand what cash you have at any particular time. And you all in congregations, just like us in higher education, and probably in social services agencies too, understand you can balance a budget, but also be at a point of your fiscal year where you run out of cash to pay bills. So, and Aaron, you kind of alluded to this already. When, I would think that for a congregation, the two big cash times are Christmas and Easter. I mean, that's just life in a congregation. In higher education, the big bumps are typically in the fall and in the spring, just after the January term. And your goal in the budget, so I kind of think, and I can't put my hand on this, but if you manage to have a positive margin each year, basically what you're doing is moving the cash flow line up each year. So what we found interesting is this, for our institution, FY07, which you can barely see here, was a pretty tough cash flow year for Concordia, Texas. And the reason was that's the year we moved. There was a whole lot of other money flying around when this was going on. And our objective was in the subsequent cash flow years to begin building up the amount of cash we had. And this FY10 dipped lower here because of some changes in healthcare and things, but eventually we continued to build it up. But I think a month to month cash flow is really important. It should include, and so you can model the real numbers, but you can use historic data to help you forecast cash flow. And also, and I call it FY plus, is to forecast your cash flow into the next fiscal year, so you have some idea of where you can start. We live by this, this in your own congregation or shop or a social services agency, that monitoring cash flow is really, really important. And the resolution of that cash flow can be very important too. So let me go to the next slide here.
So Tom, may I ask, was that, so you had cash and there was a credit borrowing, so I assume you had a line of credit to assist you through those ebbs in cash through and that's seasonal, I would suspect.
Yes.
Given the nature of a school.
And down here, again, because of the move and the way this whole thing worked out, we actually used a line of credit. You see where I'm showing right here? Yeah, but the rest of the time we didn't need it. And by the time we got through that year, we were moved up enough. I don't know that we've used it since then, but great point, Dan, and very important to understand that when you have these ebbs and flows, the question is kind of line of credit to help you get through those.
So I guess for the pastors in the room, does church ever contemplated a line of credit for seasonal giving challenges?
We have a line.
Do you?
Yeah.
And Dan, can I throw in the issue with the line of credit is when you can't pay it off after you've used it, when you accumulate credit deficits because of that.
Yeah, that's a very relevant conversation. We do very limited pieces of line of credit type financing, just church space we've found, yet we're very interested in what the market might say to that going forward, because there are some opportunities, but to Tom's point, you borrow, it's a credit card. And if you don't have the discipline to pay that back, when that cash does start flowing back into the organization. And if you don't have awareness of that, it can turn into a nut that's really tough to tackle. And now it becomes debt that is somewhat permanent and you have to pay off over time, and it loses its functionality. And church, generally speaking, is not accustomed to that type of loan. I'll use the word facility, but type of vehicle. So, but we're really interested, MIF, in where that might go, because we do know there are churches that have lines of credit, and if they're responsibly managed, I think there's a real opportunity there to support the church.
Yeah, and it's a management tool. I'm going to move a little quickly through a couple things because this is great discussion. I really appreciate it. But there's two important things towards the end I want to get through. Modeling cash flow, again, is real data, forecasting, and then updated monthly. The point I want to make here is there are times when you may need to watch your cash flow more closely than monthly. And that may deal with a significant project. You may monitor cash flow for a construction project differently than you monitor it for your annual budget. But just understand that you have the flexibility to do that. And when you miss from your actuals to your predicted based on your actuals, you need to understand this, what happened, and stick to an analysis of that. Audits, this is a big deal. I got to give you, I told you my dad was a Federal Reserve auditor. He was a great guy and was the treasurer for life of the congregation that I grew up in, which is something you shouldn't do to any person inside a congregation, okay? Or an agency, to be the treasurer for life. But I don't care what type of organization you are, you should always have an annual audit. And at most, maybe stretch that to every other year. There's just too much potential for fraud, for mistakes, not necessarily with evil intent like fraud, but for mistakes. And the other thing an audit makes you look at is this thing called internal controls. Do you all understand what internal controls mean? Internal controls are the systems inside your congregation, your social services agency, or your shop to make sure that you are disciplined in how you write checks and what you do with your money. So, for example, at the university, our internal controls were when I submitted a travel voucher, the CFO reviewed my travel voucher and signed off on it. When a vice president did submit a travel voucher, I and the CFO reviewed it. There's always at least two people involved in major financial decisions, or when cash is checked out, checks are written, and things like that. So this question of audit is incredibly important. This organization I worked with over the last year and a half hadn't had an audit in 3 years. That is absolutely and completely unacceptable in life. The audit also helps you determine these things, which is a statement of financial position and then a statement of activities, otherwise known as a P&L sheet. The statement of financial position tells you at a point in time where your organization is. And it looks at this question of net assets and what is composed of assets and liabilities. So it is a point in time. The statement of activities is performance over a period of time. So it might be for the period ended, like I have here, 2017, or for the fiscal year ended June 30th, 2018. It takes into account all these types of things, each one telling you a little different perspective on the financial position of your organization. And then finally, a statement of cash flows that is a third piece of really understanding your institution. So I'm going to stop there for a minute because I've only got some summary things after that. But audits, statement of financial position, profit and loss statements, statements of activities, and in this question, statement of cash flows. So I'm going to ask our congregation people this right now. When was the last time you were audited as a congregation? Do you know?
We do one every year, but it's internal. It's internal. It's not like we hire somebody.
Okay. I would, and Rick, you've been in congregations, and Paul, you too. If you do that, I would still periodically have an external audit firm look at an audit on some type of schedule. Dan,
and we do that every other year.
Yeah, thanks, Paul. Dan, when you look at congregations, what are your expectations for audits?
Oh, yeah. I mean, they're generally quite favorable. We don't require it, obviously, and the word audit kind of gets, I think, sometimes misused, because there are, in some cases, and church might use the word audit, but it's something that's done or internally. There are external audits there are different types of form of audit as well, and obviously price point can drive to what nature that audit looks. So it's a quite misused term, generically speaking, but having a third party at least review and know that the information that's being presented is generally speaking relates to accounting rules and is in the right accounts, that is something that we do encourage and look at favorably.
And you'll see in the book that I recommended this term FASB, Federal Accounting Standards Bureau, and FASB standards help you understand how some of these things are done.
Yeah. That's the golden rule, yes.
Yeah, the golden rule. Rick, go ahead.
I'd also like to hear more about the internal controls, because what I've found is that small nonprofits and congregations usually just don't have enough people involved to have overlapping controls. Even Paul Hansen's shop does a really good job of this, but even with that was a lot of work to get who receives the money, who puts it onto the computer, who pays checks, to have redundancies is hard.
Yeah.
I'd love to hear how churches do that, because that's stuff that pastors don't often even watch, or those are old rhythms that have been established, whether healthy or not healthy.
Dan, you have
in a church, in a church or in the fundraising shop, it's as simple as how many people are there to open the mail, how many people are carrying the offering back to the office, right?
Yeah.
I mean, you can't just have one person take the offering plates back and go in the office. That's where it starts. You got to have two people, and they're both there, and they both sign off, and then two people count it, two people add it up, and two people sign it, and then one person can take it to the bank. But and where it really falls apart is with the youth group or the WELCA. We're going to collect money for the scholarship fund, and everybody hands it to Mabel, and Mabel sticks it in her purse, and then she takes it to the church office on Thursday and dumps a bunch of 20s on the desk. All that kind of stuff is the kind of discipline that is kind of hard to bring to a congregation, especially a small one.
Yeah. Paul, I really appreciate the question about other activities, because you'll see that in all kinds of things at a church, or even another type of nonprofit agency will do. And it could be the golf tournament. If you're running a fundraising golf tournament, how are you having internal controls over what happens to the money that's given for, whatever you can imagine, mulligans in the golf tournament. So
we thought we were doing a really good job, and then we said, how many checkbooks are there? and the youth group had an account they'd opened up, and the National Youth Gathering had an account they'd opened up, and Welke had an account, and someone else had a charge account at Ace Hardware, and so we had all these things that weren't really even in our own bank. And I tell you what, that's where you get into it. It's not the church council; it's the youth advisor saying, "What, you don't trust me?"
Yeah.
And then you have to manage that stuff.
And actually, the answer is yes, we don't.
You're right.
I'm just saying, we're all human beings, right? And people shouldn't, whether you're the president or chairperson, they shouldn't trust you either. That's just the way it goes.
It's for their own protection in many ways.
Exactly.
I mean, that's how we sort of frame that too when we get into that conversation.
And I think that's where an external review can really be helpful in asking tough questions in this particular area of internal controls too, on what's happening with the money. And I'll use my dad. This was the oldest Lutheran congregation in the city of Pittsburgh, but my dad did it all, took it to the bank, did everything. There were no internal controls. Thank goodness he was a really honest guy, but plus he was an auditor, so he knew it too. I am going to go ahead to our last slide. You can read these questions about profit and loss statements and financial position. Just remember, one's a snapshot, one looks at a period of time for the organization. And we've already talked about these questions about cash flows and other potentials. Here's the bottom line. We got to be good at this because it deals with the sustainability of our organizations and our congregations and our missions. And again, you don't have to be a CFO, but you need to know what questions to ask. And like Paul and Rick brought up, maybe this is something we need to have an internal control on just to make sure that we're doing the best thing we can for our social service agency or congregation. We're over, but we've got time for a couple questions if you want to throw a couple on the table here.
I just might ask for just a moment for the group too. The ELCA uniquely has, through the Office of Treasurer, has quite a few of those financial best practice tools. If you go to the ELCA's general website and look up that Office of Treasurer, and it will lead you through, and there's some very, very good document there to help with audit, dual control of money, a lot of just guidance and best practice on how to handle some of the finances of the church. So as a resource, that is available to you. Nice, thanks.
Any other comments? Everybody really excited about cash flow and financial sheets and internal controls? We all wound up for this stuff?
Tom, very excited. Well, we live it daily, honestly. So, yes, sort of hits home for the folks on the financial side of the conversation.
Yeah.
I think, Tom, the question of depreciation and is there a difference between financial best practices in a congregation versus anywhere else with respect to depreciation? I think that could be a pretty robust conversation.
Yep.
Yeah.
And I think an argument could be made that there are good reasons not to do depreciation, not just that we're not sophisticated enough in the congregation. But I mean, it's complicated, and that's the place where my head starts to turn circles.
Hey, Paul,
particularly when
Paul, can I ask you?
Yeah.
Just because it's fun to ask you questions. For congregations, I mean, it'd be true for Luther too, but more for congregations, and I'll put it provocatively, should there be a profit margin at the end of the year? I know it's zero based in the sense of oh, we're just going to try to spend the money that comes in according to the budget, or is part of our budgets always to have 3% a margin on as a pad or whatever you want to call it?
Yeah, I mean, I think that's sort of the kitchen table way of doing depreciation, is to say, we have an escrow fund, or we have a cushion going forward in case we have to fix the roof,
Right.
But I don't know a philosophical answer to that, Rick. Sorry.
Rick, we ask the same questions at the university level as to what type of margin we should shoot for. I mean, do we need to zero the budget out? And we kind of came down to, we varied from 3% to 4% positive margin each year, just as an investment fund for the potential for new programmatics and things. And we did also fund depreciation in our budget. So that was the bag to fix the roof or the boiler or the heating plant or the air conditioning thing.
You could make the argument that in a congregation, the cushion remains with the people, right? When I give money to a church, I don't give that sacrificially so they can sit on it. Yeah. I want them to put that into ministry, and if they need more, I hope they'll ask. So I think there's a way that if you get too cushiony, you're gonna have a downward effect on giving.
Great point. We are now 10 minutes over time, so I thank you all. And we'll send a note. Let me remind you that we do not have a webinar in July. Our next webinar is on August the 8th at 12 noon on building a leadership culture. And we got 2 great speakers for this one. So send out the slides and send out a reminder on that. All the best.
Thank you, Tom.
Great. Oh, you bet. See you all. Thanks for the great questions. Thank you for the great questions.